Hello dear students, myself CMA Padmaja Buzruk. I will discuss accounts of joint stock companies. Please go to study note number 1, accounting of shares and debentures. Let us see the definition as given in Companies Act. Section 2 subsection 20 of Companies Act 2013 defines a company as company formed and registered under this act or an existing company. Under this act means under Companies Act 2013. Existing company is a company which was in existence before Companies Act 2013. Now we'll see characteristics of a company. Joint stock company is an artificial person created by law. It is not natural person. Law creates joint stock company and law can only dissolve it. Second characteristic is liability of member, that is shareholder, is limited to the extent of face value of shares held by them. That means at the time of winding up of joint stock company, if assets of joint stock company are not sufficient to pay liabilities, then in that case, shareholders will suffer only to the extent of face value of shares held by them. Unlike proprietors and partners whose liability is unlimited, that is, they need to contribute from private estate, if assets are not sufficient to pay off liabilities at the time of winding up. So, liability of shareholders, members is limited only to the face value of shares. Next characteristic is joint stock company has a perpetual succession. Perpetual succession is continuous existence. Existence of joint stock company is altogether independent of life of its members. Death of member, insolvency of member will not affect existence of company at all. So that means it has a continuous existence, that is perpetual succession. Few more characteristics. Joint stock company acts as an individual. Joint stock company can hold, can purchase, can sell movable as well as immovable property in its own name. It can incur debts, it can pay debts, open bank account in its name. It can sue and sued in the same manner as an individual. It's just like a person, it can do everything in its own name. So it acts as an individual. Next characteristic is ownership is divorced from management. In case of joint stock company, shareholders are owners who provide fund, but they do not manage the business. Joint stock company is managed by board of directors who are elected by shareholders. Next characteristic, shares of company are freely transferable except in case of private limited company. Shareholders, members of public company can sell shares freely in the share market, but this is not so in case of private limited company because there is restriction on maximum number of shareholders in private company. Now we'll see what is public company. A public company under Companies Act 2030 means a company that is listed on a stock exchange and can sell its securities to general public. So if these conditions are satisfied, you can call company as public company as per Companies Act 2013. That is a company which is listed on stock exchange and company which can sell its securities, that is shares, to general public. To become a public company, the company needs to offer an IPO to the public. IPO is initial public offer. First issue of shares by companies are made through IPO. That is when first time company becomes publicly traded company on National Stock Exchange. When first time company asks public to subscribe for its shares, it gives advertisement in the newspaper, ask people to purchase shares of the company for the first time, it is IPO. FPO is follow-on public offer. When already listed company subsequently ask people to subscribe for its shares, it is known as FPO, follow-on public offer. These FPO and IPO terms are applicable to public company. Publicly listed company means their shareholders can sell securities freely on stock exchange. Just now we have seen this. Securities are shares. Public company needs to disclose its annual report to all stakeholders. Annual report is financial statement, profit and loss account and balance sheet, along with auditor's report, which auditor has expressed his opinion on the financial statements. So it is necessary for public company to disclose this annual report to all stakeholders. Who are these stakeholders? Shareholders, prospective investors, money lenders, debtors, creditors, employees, tax authorities, government, competitor, etc. etc. All these are various stakeholders who are interested in financial statement of the public company. A public company can expand its business by issuing more shares to general public. Company ask general public to subscribe for its shares through an FPO, that is follow on public offer. More shares are offered to the public. Now we'll see what is distinction between public and private company. First distinction is listing of securities, shares. Securities is shares on stock exchange. Public company refers to a company that is listed on recognized stock exchange and its shares are traded publicly, whereas private company is one which is not listed on stock exchange and its securities are held privately by members. Next, this point of distinction is disclosure of financial reports. Public company needs to disclose its financial reports quarterly and annually, whereas there is no such obligation for private company to disclose financial results to normal public, to general public. Next point of distinction is minimum number of members, minimum number of shareholders. Minimum 7 members must be required to form a public company, whereas minimum 2 members must be required to form a private company. Next point of distinction, maximum members, maximum number of shareholders. There is no maximum limit of members in public company, whereas maximum limit of members in private company is 200. Next point of distinction is number of directors. At least 3 directors are required in a public company, whereas at least 2 directors are required in a private company. Now we'll see statutory books. Statutory books are those books which a limited company is required under statutory obligation to maintain at its registered office. The books which are required to be kept maintained by law, by statute, are known as statutory books. Register of investment held and their names. If company has excess money and they have invested in some other company's shares, debentures, it is necessary to maintain register of these investments. Next is register of charges. If company has taken loan from banks, financial institution on the basis of security of assets, then these loan taken on the basis of security of fixed assets, they are charges on assets, and for that register is to be maintained, which is known as register of charges. Register of members is register of shareholders who are owners of the company. Register of debenture holders. Debenture holders are creditors of the company. It is necessary to maintain register of debenture holders also. Annual returns, that is returns filed by company to income tax authorities. Few more statutory books. Minute books. Minutes are nothing but extracts of meetings. It is necessary to maintain this statutorily by companies. Register of contracts. Company enters into various contracts. It is necessary to maintain register of all these contracts. Register of directors. Register of shareholding of directors. If shareholders are directors, that means directors have some part of some shares of companies. In that case, it is necessary to maintain register of those directors who have shares of the companies. Register of loan to companies under the same management. If loan is given by company to some other company which is under same management, then register of that is to be maintained. Books of accounts. Every company is required to keep at its registered office books of accounts. These books are to be maintained in such a way so as to disclose sums of money received and expended by the company, that is receipts and payments, all sales and purchases of goods of the company, all assets and liabilities of the company. So in short, which books of accounts every company is required to kept at its registered office? Books of account relates to receipts, payments, sales, purchases, assets and liabilities. Next important part as regards company is share capital. Division of share capital are nominal or authorized or registered capital, issued capital, subscribed capital, called up capital and paid up capital. So one by one we'll see all these terms. Nominal, authorized or registered capital is one and same. It is the amount of capital with which company gets registered. It is the maximum amount which the company is authorized to raise by way of public subscription. There is no legal limit on the amount of authorized capital, but remember it is the maximum amount which company is authorized to raise. Issued capital, it is part of authorized capital which is offered to the public for subscription. Next is subscribed capital. Supposing if company asks people to subscribe for its shares, it is not necessary that company will receive same number of applications. Number of applications received will be more or less than what company has asked for. If company receives more number of application, then that is the case of oversubscription. If company receives less number of applications, then that is the case of undersubscription. Subscribed capital is that part of issued capital for which applications are received from the public. Now supposing if company has asked people to subscribe for 10,000 shares, and if it has received only 8,500 applications, then in that case 10,000 shares multiplied by face value is issued capital, and 8,500 into face value is subscribed capital. But if company has received 10,000 applications or more than 10,000 applications, then in that case issued capital and subscribed capital would be one and same. 10,000 multiplied by face value. Called up capital is the amount on shares which is demanded by company. Demanded by company to shareholders. That is called up capital. Company keeps calling face value in installments, various installments, and the installments which company has asked shareholders to pay is called up capital. Paid up capital. Paid up capital is part of called up capital which is offered and paid by members. Sometimes some of the shareholders, they do not pay certain amount due on calls, certain installments. They make default in payment, which is known as calls in arrears. So called up capital minus calls in arrears is known as paid up capital. I'll give you one example so that it will be very clear to you. A company is registered with 1 lakh equity shares of 10 each. 1 lakh equity shares of 10, it got itself registered. This is the maximum capital which company can subscribe during its lifetime, 1 lakh. But of course, company can increase this registered, authorized or nominal capital by passing a resolution. Amount payable on the shares is as follows: 5 rupees on application, 2 rupees on allotment, 2 rupees on first call, and 1 rupee on final call. Face value is 10. Company keeps calling in installments. There are 4 installments: application, allotment, first call, and final call. When the people apply for shares, they have to pay application money. If they do not pay application money, shares are not allotted to them. So, shares application money is to be paid along with application. So, these are the installments. 5, 2, 2 and 1 makes 10. Company issued 10,000 equity shares of 10 each. People subscribed for 8,500 equity shares. Final call is not yet made. Final call is rupee 1. So company has asked shareholders to pay only application, allotment and first call. They have not asked to pay final call rupee 1. All amount up to first call has been received by the company, except one shareholder having 100 shares did not pay first call money. All amount up to first call has been received by the company. Company has not made final call. Till first call, whatever money was due, they have received, but one shareholder having 100 shares, he has not paid first call money. Now, what would be authorized capital? 1 lakh into 10. What would be issued capital? Company has issued 10,000 equity shares, 10,000 into 10. People have subscribed for 8,500 shares. So subscribed capital would be 8,500 into 10. Company has called only 5 plus 2 plus 2, that is 9. So called up capital would be 8,500 into 9. On 100 shares, it has not received first call. So 100 into 2 is calls in arrears. And called up capital minus calls in arrears is paid up capital. See this solution. Authorized capital 1 lakh into 10, 10 lakhs. Issued capital 10,000 into 10, 1 lakh. Subscribed capital 8,005 into 10, 85,000. Called up capital 8,500 into 9 because final call is not yet made. Company has called only 9 per share, 76,500. On 100 shares, first call is due. Company has not received 2 rupees on 100 shares, which is calls in arrears, 200. Called up capital minus calls in arrears is paid up capital, which is 76,300. Company asks shareholders, members to pay face value of shares in various installments. Just now we have seen. These installments are application money, allotment money and call money. There can be only one call or two call or three call, depends upon policy of the company. Last call is always known as final call. If there is only one call, then that call is known as first and final call. Application money, 5% of the face value is payable with application money, minimum 5% or more. Some money on allotment and some money on calls as per the policy of management. Now, when company receives this, you are supposed to pass journal entries. These journal entries are: when company receives application money, bank account debit to share application account. And this share application money you are supposed to transfer to share capital. So share application account to share capital. So share application account 1 debit 1 credit, net effect is bank account debit to share capital with application money. Supposing if company has received excess applications and it has decided to refund application money back, then exactly opposite entry, first entry whatever you have passed when you received the money, now you are refunding it back, opposite entry share application account debit to bank. Next is allotment. Company allots the shares to shareholders. First you have to pass entry to show allotment money due. Share allotment account debit to share capital to securities premium if shares are issued at premium and premium is along with allotment money. Then and then only you are supposed to pass this entry. Share allotment account debit to share capital to securities premium. If company asks shareholders to pay more than face value, then the excess is known as securities premium and it is to be transferred to securities premium account. And when allotment money is received, your entry is bank account debit to share allotment account. Then call money due. As I've already told you, there can be various calls, first call, second call, third call, final call. But entry for all call monies will be same. Call money due is share call account debit to share capital, and for call money received, bank account debit to share call account. So we have just discussed about various concepts, definition of company, distinction of public limited company, private limited company, various divisions of share capital and journal entries. Thank you.